Right.
We're going to talk more about this.
We got two brilliant people
guests right now. More on the bond market, the recession warning, and the Fed. We're joined now by University of California, Berkeley economics professor Brad DeLong, who's also a former Deputy Assistant Treasury Secretary under Clinton, and Romina Boccia, Heritage Foundation's Center for Federal Budget Director. We're also joined by Jim Urio, who was commenting on bonds yesterday when we got some data, Jim, and talking a little bit about what this means for recession risk and when we could see that. But I want to start with you, Brad, because it's not as if unemployment is high. There are questions about whether the U.S. can continue to issue debt to pay its bills. So what is this actually telling you right now?
There are no questions at all about whether the U.S. can continue issue debt to pay its bills. Look at the interest rates on the debt. Look at how extraordinarily valuable the debt is. People worldwide think that holding U.S. government debt is an extraordinary good thing to do, and it has an extraordinarily high value. I don't understand why you can say that there are questions about whether the U.S. can continue to issue debt when everyone out there wants it and wants it at a very high price.
It's a high price compared to what they are getting for their money anywhere else around the world, Romina.
No, just high price in general. U.S. bond, create $1 of cash flow and sell it as a U.S. government bond, and it has a uniquely high value, save perhaps for Germany and Japan, where it's even higher.
Romina,
you're just talking relatively today, not relatively in life, because otherwise it doesn't have a high price at all.
It does too. Have 30-year Treasury bonds ever been this high?
The price is not.
No.
The price is not. It's Brad, real quick, how worried are you about this yield curve inversion?
Not the yield, the price.
Look, the market is honking the horn very loudly at the Federal Reserve. The question is, does Jerome Powell have a better sense of how to maintain the expansion, or is the market right to be worried? Given what we've seen over the past 40 years, you'd be well advised to bet on the market, and I think Powell is going to respond, which is why everyone expects interest rates, the 3-month rate now, to be 75 basis points lower in January than it is today.
But Romina,
someone's honking the horn at the economy, and the Fed is responding.
And the Fed responded in July, certainly. But Romina, how much longer do you think the Fed is actually able to expand or to extend this expansion?
You know, this is a really tough question, and ultimately the market is going to decide this. But the Fed shouldn't concern itself with facilitating fiscal policy for the U.S. federal government to enable this huge borrowing spree that we're witnessing. We're looking at potentially almost $1 trillion deficit this year, certainly next year. The interest cost alone will exceed what we'll spend on all of Medicaid at the federal level. And over just the next 5 years, it looks like interest on the debt may actually exceed what the U.S. federal government spends on national defense. So while the U.S. debt is still in high demand, we got to keep in mind who is backing that debt. It's the U.S. economy, it's the American people. And if things should turn for the worse, those interest rates could spike relatively quickly, and that could get us into real trouble fast.
One of the reasons, Romina, though, why President Trump has advocated for lower rates is so that the cost of government borrowing would go down because of the expectation that it would be issuing more debt. But what happens if we do go into a recession, if corporate tax receipts get lower? And does that offset any potential cost savings from low interest rates?
You know, the Federal Reserve, it should be independent. That's the whole purpose of having an independent central bank. We get in real trouble when they see their mandate as facilitating fiscal policy for a government that is spending out of control and borrowing at excessive rates. The fiscal situation is unsustainable, not just in the long run, but also in the short run. And that's a real problem. Now, we have to see what the markets will do, but I do worry that we're finding ourselves in a bubble, and the longer we try to extend it, the deeper that fall will be.
I want to ask